First of all, I want to put a disclaimer on this. This is not tax advice. I'm not an accountant. I'm just Phil, a guy on the internet. However, I'll share my personal experience and understanding and offer some tips from the perspective of a property investor. Why would you even think about this argument? Buying in your own name versus a limited company? The main reason is taxation. If you own a property in your personal name, the income that asset produces will be added to your personal income at the end of the tax year. However, if you buy through a company, the income generated from that asset goes into its own entity. The profit within that company at the end of the tax year is subject to corporation tax. But before we go any further, I just want to quickly say, if you're finding this content useful, please hit the subscribe button. We post twice a week with valuable tips for property investors like you. And if you're not subscribed, you're missing out. Plus, it really helps us continue creating this content. So go ahead, click that button. Don't be the one who watches all the videos and never subscribes. One real advantage of owning property through a company is the range of expenses you can claim. For example, in a company environment, you can deduct interest payments for the property, which isn't possible in a personal environment due to the Section 24 tax changes. You can also claim travel expenses if you're traveling between properties to look for investment opportunities. These expenses are also eligible for corporation tax relief because they're related to operating the business. That said, there are downsides to consider. First, the money used to purchase the property needs to be within the company. If you have the money personally, you'll need to lend that money to the company, or the company will need to generate enough profit for a deposit or purchase. Another downside is that lending costs are generally higher in a company environment, often around 2% higher than personal lending rates. For example, at the time of recording this content, a personal buy-to-let mortgage might have a 5% interest rate, where as a limited company, you could face rates of 6.5% to 7%. Additionally, even with a limited company, most UK lenders will require a personal guarantee, meaning you're still personally liable for the debt. You'll also need to factor in the costs of running the company, including accountancy fees and administrative work. When deciding whether to buy personally or through a limited company, it's crucial to evaluate your personal circumstances. If you need all the income from your property personally and aren't planning to buy many properties, then the additional costs of running a company might outweigh the tax benefits. On the other hand, if you're building a long-term portfolio, a limited company can help you save on taxes and reinvest profits. From my personal experience, I had a liquidity event a few years ago where I sold a company which provided me with a lot of personal capital. I lent that money to my property company, which then purchased the properties. The income generated by those properties remains within the corporate environment, allowing me to claim genuine business expenses such as travel and operational costs against the rental income. This has reduced my tax liability while growing my portfolio. For many investors looking to build wealth or retire with a supplementary income, setting up a limited company can be a smart move. It's quick to set up a company and a bank account, so you don't need to worry about delays if you choose this route. Ultimately, the decision between buying personally or through a company depends on your personal income, financial goals, and long-term plans. Speak to an accountant to get tailored advice, and I hope this video helps you understand the key differences and considerations. If you're ready to take the next step, I've also shot a video on how to find your next best property investment deal. Click the link to check it out.